Before we get started, make sure to subscribe to the channel and turn on notifications so you never miss important retirement, Social Security, tax, and money-saving updates that could help you keep more of your hard-earned income. If you are over 65 or getting close to retirement, there is something extremely important you need to know right now. Every year, millions of retirees pay far more taxes than they legally owe simply because they do not understand the tax breaks specifically designed for older Americans. And the surprising part is that many of these tax benefits are not hidden loopholes or complicated strategies only used by wealthy people. They are legitimate IRS-approved tax advantages that many retirees qualify for automatically. Yet most people never claim them. Some retirees miss these deductions because nobody explained them clearly. Others assume they do not qualify. And many simply file their taxes the same way they did before retirement without realizing the rules changed after age 65. That mistake can cost thousands of dollars. In this video, we are going to break down 5 major tax breaks the IRS gives retirees over 65, including how they work, who qualifies, why so many people miss them, and how you can potentially reduce your taxable income legally and safely. We are also going to talk about important income limits, hidden rules, common filing mistakes, and ways retirees accidentally leave money on the table every single year. And make sure you stay until the end because the final tax break is one of the most overlooked benefits in retirement. And for some retirees, it can dramatically lower the taxes they owe. Let's get started. The first major tax break retirees over 65 receive is the higher standard deduction. This is one of the easiest tax breaks to qualify for, yet millions of retirees either forget about it or do not fully understand how powerful it can be. Most taxpayers can choose between itemizing deductions or taking the standard deduction. But once you turn 65, the IRS allows you to claim an additional standard deduction amount on top of the regular deduction. That means a portion of your income becomes automatically protected from federal income taxes. For many retirees, this extra deduction alone can reduce taxable income significantly. Here is why this matters. A lot of retirees no longer have mortgage interest deductions or large work-related deductions they used during their working years. Because of that, many older Americans now use the standard deduction instead of itemizing. The IRS recognizes that retirees often live on fixed incomes, so taxpayers over age 65 receive a larger deduction amount than younger taxpayers. And if both spouses are over 65 and filing jointly, the deduction becomes even larger. Many retirees are shocked when they realize they could qualify for thousands of dollars in extra deductions simply because of age. But there is an important detail many people miss. The extra deduction is not automatic in every tax filing situation. If you prepare taxes incorrectly, use outdated software, or forget to indicate your age properly, you could accidentally lose part of the benefit. This especially happens among retirees who file paper returns, switch tax preparers, or use free filing programs without carefully checking the final forms. Another important point is that the standard deduction changes almost every year because of inflation adjustments. That means retirees should never assume last year's numbers are the same this year. And here is something even more important. Many retirees think they must itemize deductions to save money on taxes. But in reality, after age 65, the larger standard deduction often becomes the better option. Some retirees continue itemizing out of habit, even when the standard deduction would save them more money. This is why reviewing your filing strategy every year is critical. The higher standard deduction can also affect whether Social Security benefits become taxable. A lot of retirees do not realize that lowering taxable income through deductions can reduce the portion of Social Security benefits subject to taxes. That creates a double benefit. You lower taxable income directly while potentially reducing taxes on retirement benefits at the same time. And this becomes even more valuable when retirees are withdrawing money from retirement accounts like traditional IRAs or 401ks. Every deduction matters more once required minimum distributions begin. Now let's move to the second tax break that many retirees overlook: the credit for the elderly or disabled. This is one of the least claimed tax credits available to older Americans, and part of the reason is because many retirees have never even heard of it. Unlike a deduction, a tax credit directly reduces the amount of taxes owed. That is extremely important. A deduction lowers taxable income. A credit lowers your actual tax bill. The credit for the elderly or disabled is designed for taxpayers who are age 65 or older or permanently disabled and meet certain income requirements. But because the rules are more complicated than other retirement tax breaks, many eligible retirees never claim it. One reason is the income limits. This credit is mainly designed for lower and moderate income retirees. If retirement income rises above certain thresholds, eligibility may disappear, or the credit amount may shrink. Another reason people miss it is because retirement income sources affect eligibility differently. For example, taxable pensions, IRA withdrawals, investment income, and Social Security benefits can all influence qualification, and many retirees assume they earn too much without actually checking the IRS guidelines. Sometimes they are wrong. Even a relatively small tax credit can still make a noticeable difference for retirees living on fixed incomes. Another common issue is confusion about Social Security taxation. Some retirees think Social Security benefits automatically disqualify them from this credit. That is not always true. The calculation is more detailed than many people realize. This is why accurate tax preparation becomes so important in retirement. A single overlooked credit can cost hundreds or even thousands of dollars over time. And remember this, tax laws change frequently. Income thresholds, deduction amounts, and credit formulas may shift from year to year. That means retirees should review eligibility annually instead of assuming previous rules still apply. Now let's talk about the third major tax break retirees over 65 often miss: medical expense deductions. Healthcare is one of the largest expenses retirees face, and the IRS allows certain medical expenses to be deducted if they exceed a specific percentage of adjusted gross income. But many retirees either do not track expenses carefully enough or do not realize how many healthcare costs may actually qualify. This deduction can become especially valuable later in retirement when medical expenses increase. And there are far more deductible healthcare costs than many people expect. For example, qualified expenses may include doctor visits, hospital bills, prescription medications, medical equipment, dental care, vision care, hearing aids, long-term care insurance premiums within limits, transportation for medical treatment, and even certain home improvements related to medical needs. Some retirees spend thousands every year on hearing devices, mobility aids, dental procedures, or prescription costs without realizing part of those expenses may help reduce taxes. But here is the key issue. You usually must itemize deductions to claim medical expenses. And because the standard deduction is larger after age 65, some retirees assume medical deductions are no longer useful. However, in years with unusually high healthcare expenses, itemizing can suddenly become beneficial again. This often happens after surgeries, hospital stays, specialist treatments, major dental procedures, or long-term care needs. Another important factor involves Medicare premiums. Many retirees forget that Medicare Part B premiums, Medicare Part D premiums, Medicare Advantage premiums, and supplemental Medigap insurance premiums may count as qualified medical expenses. That can add up quickly over the course of a year, especially for married retirees. And retirees who are self-employed may have additional opportunities related to health insurance deductions. There is also confusion around long-term care expenses. Many older Americans do not realize that qualified long-term care costs may qualify for deductions under certain conditions. This becomes increasingly important as people age because long-term care costs can be extremely expensive. Another common mistake retirees make is failing to keep proper records. The IRS requires documentation. Without receipts, billing statements, insurance records, or mileage logs for medical transportation, proving deductions becomes difficult during an audit. This is why retirees should maintain organized healthcare expense records throughout the year instead of scrambling during tax season. And here is another critical point. Medical deductions are often more valuable when combined strategically with other retirement tax planning decisions. For example, timing large medical procedures in the same tax year may help push total expenses high enough to exceed deduction thresholds. That strategy can potentially create larger overall tax savings. Now let's move to the fourth tax break many retirees miss: qualified charitable distributions from IRAs. This is one of the most powerful tax-saving strategies available to retirees over 70 and a half. Yet many people either misunderstand it or never use it correctly. A qualified charitable distribution, often called a QCD, allows eligible retirees to transfer money directly from an IRA to a qualified charity. And here is the important part: the transferred amount may count toward required minimum distributions while being excluded from taxable income. That can create enormous tax advantages, especially for retirees who do not need all of their required minimum distribution income for living expenses. Normally, withdrawals from traditional IRAs are taxable. Once retirees reach the required minimum distribution age, the IRS requires annual withdrawals whether retirees need the money or not. Those withdrawals can increase taxable in